Yo, shake my hand, shake my hand. Hope you're doing well. Listen, there's a video playing in the background, and it's pretty much marking my target. You see that there? 16,312 US dollars is a target. It's not what I've done right now, it's a target. The date today is the 14th of October. My target is until the 15th of December. That gives about 8 weeks to go, right? So I'm going to explain the rules, right? Most important part, I'll be giving out the same trade ideas I'll be taking to meet my target. So the video that you're about to watch is last night's class. Generally speaking, as a rule of thumb, we don't upload our full classes on YouTube because then otherwise, what's the point of being a private student member, all right, of the academy? This will be the second video of a full class that I'm putting up there. It's on risk management. When you see a big target like this, I need you to remember how to operate properly. So last night, I taught on risk management. Please watch the video. Please understand the rules before you start sitting through my war rooms, all right? Because my account, my capital will be different from your account and your capital. What you want from the war rooms and the trades that I'm taking is direction and as many accurate trades as possible, right? Your target is something that you need to think about for December right now. Mine is $16,312 and I'm gunning for that, right? So I hope you enjoyed this video. It's the most important video you're going to watch if you're a trader doing this thing correctly, understanding the business side of trading, risk management, so you know when I call areas of value on supply and demand, you must understand the risks behind them and how much to leverage, risk to reward ratio, all sorts of things, right? This is pretty much our part 1 in module 1 of the live class of how to grow a small account, right? So I'll see you on the other side. 365. Cheers. Right, recording started, right? So I'm gonna, last night I had a power cut, and this morning I made a power cut, and then at 11 a.m. to 1 p.m. I had another power cut. So it's been very difficult to kind of like arrange my life the way I would like it to be, because really by now I would have loved to have done all those war rooms, but then if I get interrupted or if I do a live one and the upload gets interrupted, it's just very annoying, right? But I'm almost done with them, right? Number one. And then hopefully tonight, straight after class, I can quickly upload last night's class and tonight's class all at the same time. After power cut, I forgot to come back to it, I won't lie, right? But anyways, let's rock and roll. Please don't forget that after I'm done talking for about 30 to 45, maybe for like an hour, all right, I'm gonna open up the floor for questions. Don't be under pressure, okay? Don't be under pressure. If you don't have questions, you don't have questions. But I would love you to have questions, because after I'm done talking, guys, after an hour, I am done with my module 1. Right, and I want you to know what this means. All right. So before we start class, when was the last time I did a toolkit review? Good evening to everyone who just joined us. All right, it's been a while. And why this is so important is whatever questions you ask me or don't ask me, all right, completely up to you. But whatever questions you do or don't ask, you have to know that I won't know what you don't know. And you will learn that you don't know it when you are in the markets. All right, so there's a very, very important time period for us. So please, if you have any questions, feel free to shoot them, and then I can then deal with them on site, right? Also, for me, what it does is it helps me sometimes kind of like figure out what I might be doing wrong as a communicator. It helps me improve on my pedagogy, right? So the actual practice of delivering information, right? So it's fundamentally absolutely important that I know where people are lacking and all that kind of stuff. So please don't hesitate to let me know. The person I'm with, the mother of my beautiful kids, she never said yes to me the first time I asked it. So I always tell people, because of that, I'm a very strong human being. I know how to handle rejection. So it's not a space for you to cuddle. Like if I wasn't clear about something, or you want clarity on something, you have to tell me. You literally have to tell me that, look, Leroy, please break this down, etc. I'd far much more rather use the last 1 hour of the class doing that than starting module 2. All right, I want to be very, very clear on that. But again, it's completely up to you. It's really up to you. If there are no questions, which is also fine, which means I've been very much clear and everybody is safe, feels safe enough to be okay with that, then all I'll then do is happily start to build on that. I'll start to move on and start to kind of like start to equip you on the introduction of module 2, which we'll start off with tomorrow. All right, and then maybe some feedback. So even if you don't have questions and your feedback on the course, was this a waste of your time? You know, that all that kind of stuff is very important. But just to help you structure your minds, whether there are going to be questions or no questions, this is something that I expect you to know from my perspective, right? So I'm just saying, as someone who's kind of like showed up for the last 4 weeks with you and taught you, from my perspective, the assumption is you know the following things. Number one, you know that there are 5 types of supply and demand. You know that. And you just don't know it as someone who watches my YouTube videos but isn't in our classes. You know this as a registered 365 student, which means that you just don't know that they exist. You know how they work. You know the rules behind them. All right. So number one, you know that there's something called major turning points. All right. It's supply and demand. Number one, major turning points. You know that major turning points is constructively what we did. Right, so you need to know a couple of things about major turning points, right? This is literally where you are right now. Number one, you need to know that the major turning points are only show up on one time frame. They are everywhere, but they are much better understood on one time frame. We call that the governing time frame. Right? I quickly just mute everyone there, so just kill the feedback. Right, so there's a governing time frame perspective on major turning points. You know that this is not enough. It's not just for fun. Major turning points have the ability to craft long-term banking trends. This is step one. Why? Because we're not playing games in the markets. We're not trading any just junkyard strategy. We understand that we are nothing but retail traders, and we really want to give ourselves a marketing edge. And the marketing edge in the markets, not marketing like advertisement, but actual markets, is the fact that we are going to do our level best to understand what big institutions are doing and then mimic that in our smaller accounts to grow them. So the governing time frame gives us the perspective of the 3 months. Banks think in 3 months. The fact that they will always cut us off in a year, they'll cut themselves, they'll always take profit in a year. And generally speaking, we know that the markets are not for traders. The markets are linked to geopolitical events. They're linked to trading, export, imports for countries. They're linked to so many things outside of just trading. And so because of that, they are governed by fiscal, but more specifically, monetary policies, which generally have a 10-year plan. So someone like the FOMC, he outlives presidents, right? His election and his run for power is generally longer than a president. So FOMC, Jerome Powell was around during Obama. He's currently was around during Trump, and he's still around now with Biden. And I'm pretty sure he wants to run for another term, right? And his terms are longer because the financial markets are big. It's a big, big machinery that needs bigger consistency. All right, so our governing time frame does a good job of doing that. All that is nice and well, but what we're really talking about when you boil down to it is the relationship of the biggest supply and the biggest demand on the chart, which pushes charts, pushes money through time. Right, so that's our major turning points. As we were dealing with major turning points, we spoke about a lot of things. You're going to go back to those videos and I encourage that. Remember, guys, golden rule. If you join my remote course, all right, it doesn't apply to you anymore, but if you join my remote course, the next live classes I run, all right, my next live classes, I hope to God, are not in November. I'm tired, man. No offense to anyone, but maybe next year, right? But any live classes I do are completely free for registered students. If you join 365 through a live class intake like this one, and it's your first time doing the live classes with me, next year, when I have my 3 or 4 live classes throughout the year, all right, I don't know if I'll ever go back to teaching every single month. I doubt it, but I love it, but it's really draining. But anyways, all those live classes, you have access to them for free. There will not be a $10 fee, a $20 fee. There'll be zero. You just come and you refresh, you rebuild, you pick up where the gaps are. right? As I get better and evolve with explanations, right? Well, the one thing that we're all going to do together next year is probably have our first live run through of module 3, but I'm going to dump it in the remote course first before December. And then we're going to meet up and I'm going to break it all down live again. But all my live classes are for free. It's just a reminder, please, next year, when you've now got a big account and you think you're too cool for school and then you blow it by mistake one day, you're always welcome back, whether you blow or you don't blow. I learned through constant learning and repetition. But anyways, we spoke about areas of value. All right, so that's what we dealt with next, areas of value. And we spoke about the different types of areas of value. Not knowing this is going to affect what I want to teach you tonight, risk management. My stuff is so interlinked. The moment you master drawing areas of value correctly, all I'm doing tonight is attaching the business model. Guys, if my mic is shaky or I mean, 2 days ago, I did a long YouTube video and the sound was terrible. So please always alert me if I'm moving too much and it's affecting sound quality. Né? But areas of value are the starting point of risk management. No one will ever teach you that. A poorly drawn area of value will cause you to under risk, tight stop loss, or over risk, way too big stop loss. A tight stop loss or overly extended stop loss will affect profitability because it will affect risk to reward ratio. We started risk management in week 2. We just don't label it like that because it will get your mind thinking too much. Our areas of value are significant. We take pride in them. This is where we stake stand. Our areas of values where we say, come hell or high waters, I'm defending this place. This is where I'm buying, this is where I'm selling, based on my understanding of supply and demand. So we spoke about a couple of areas of value. Let's see if we can quickly break them down. Number 1, we spoke about a fresh area of value. Please remember the rules for that. I'm just building your toolkit. I'm just building your toolkit. Fresh area of value. We spoke about a retest or tested area of value and what qualifies as a test for us, right? Inside here, we brought in a very important concept, right? That of glass effect. I won't repeat that story of my windscreen. And then we started to talk about the areas of value that banks create themselves. Right, because we're doing module 2 and module 2 is so quick, I can start to focus on my COT videos for YouTube. Watch those, right? I'm gonna start not this week because I'm behind already, but from next week when I start shooting COT videos, right? And I start to teach you how to break down COT data. So it's going to be part of module 3, but I want to just start introducing it right now. You will then notice why some areas of value are more special to me because I literally know there is 23,000 buy orders there. I'm going to teach you how to extract that information. Glass effect is an important tester. A bad area of value that is now falling into our glass effect theory, you're guaranteed you're going to lose money. So don't take it. All right. So then we spoke about areas of value that the banks create outside of the structure we're looking at. We are seeing markets leave a demand, going to a supply. But before price gets to a supply, my baby is very close by today. In the other room, mommy's making a special supper. So we know we're going to be a little bit patient with them, but they will try to keep it down. I hope that's okay with everyone. Right. So there are some turns that markets will create to interrupt the journey between supply and demand. The first thing I promised you guys from lecture 2 of the course was markets are not random. Whoever told you that markets are random was lying to you. They are not random. Markets are not random. Because they're not random, we can plan it. We can speculate. We can, as accurately as possible on a scale of probabilities, predict where price is going. I gotta tell you guys, because of power cuts, I took a nap at 11 a.m. today. 11 until 1, and my goodness, that thing made a big difference in my life. I have never felt so okay for class. I'm gonna have to like schedule in naps now during the day. I feel like a 6-year-old with so much energy. So let's hope we end on time and I don't go until 9 p.m. It's a joke. I won't go over time, right? But original turns done by the banks. Then we obviously say if they're original turns done by the banks, a lot of the times, logically, an original turn will create an area, a fresh area of value. So there is credence to this because it means you can take an original turn twice if you really think about it. All right. After we did all of this, we said, look, man, talking about major turning points and areas of value doesn't really connect us to supply and demand. We're not yet there. What's missing, Leroy? Well, there is the tester. We built all of this into supply and demand, number one, knowing it will be the stencil, right? It'll be the tracing point for every single supply and demand I'm going to teach you throughout the last 5 weeks together. So we started to talk about the golden rule. The golden rule of supply and demand is our imbalance rule. We never leave the house without this rule. Without an imbalance, we don't have a trade. If we don't have a trade, we don't have an imbalance. If we don't have an imbalance, we don't have a supply or a demand. We can have a support or resistance. Markets can be overbought, oversold. All the indicators could be screaming buy, buy, buy. As a 365 trader, you do nothing. You touch nothing. You do not contribute to someone's account. That's what you're doing. Every time you take a trade that does not give you a valid imbalance, you are saying, I don't give a damn how hard I've worked for this money. Here, better trader on the other side of the internet, here's my money. We never take a trade that is fundamentally not given. We will still have many other problems. An area of value could give you an imbalance and still go against you, right? We spoke a lot about those things in multiple time frame analysis, but this is a basic rule. The best thing you can do for yourselves, guys, is have a checklist. Man, I should probably film the other side of my office, both here and corporate. You should really see I am surrounded by checklists. I am always surrounded. You see this? I didn't have to open any of them. I'm ready. I'm looking at assets that I was looking today for CPI. I rewrite my checklist. The one that I created, the one that I gave to you, the one that I've mastered for the last 3 years, the one that I can repeat in my sleep. I constantly go back to it. I never want to fall for a trap like that. I never want to catch my emotions flurried. CPI was positive. Do I rush to buy? No, I have to wait. I just dropped my live commentary on CPI, just a 15-minute video, right? And I once again proved it today that you should not be losing money trading news events. The thing is, in Sikosa, they say, you just rush, you just want to jump in. And that's not something you should be doing with money. Even with news events, you can wait for 5 minutes for price to show you the direction and to come back to an order block, right? We'll talk about order blocks later. But then golden rule, imbalance. And then once I felt that I had kind of like dug the foundation with you guys, it took about 2 weeks, I think, of the course, 2 to 3 weeks to get through this stuff. We then started to introduce supply and demand number 2, which was our favorite 365 candle. But not only that, it was our first type of supply and demand that is a potential continuation pattern. This is important because if you don't understand that there are some areas of value that the banks use to put a little bit of money, and there are some areas of value that the banks use to put a lot of money, and the areas of value where they put little bit of money are valid areas, as long as we know what we're doing. I think it was with you guys last week where I took you to one of my live accounts and I showed you guys the oil trades, right? And how on the daily time frame, I was waiting for a drop to a daily demand, but markets used the PCP on H4 to stop price from falling to go back up. Why? Because they're in a rush. So this morning again, I'm back in oil, right? I found a smaller demand on the 15 minutes time frame in line with a lot of things, a little bit higher than where I'd want to buy. I haven't changed my mind about the demand at the bottom, but I want to see if I can get a quick rally up. You know, I just feel like I should have been on that oil trade, but this is what we use, and it's a 365 candle. We use these PCPs continuously. These PCPs, they come with rules. First of all, there is a rule about the type of areas of value they create. Classified sensitive, one touch only, no retest, right? Remember that kind of stuff. Also, we need to remember the relationship of PCPs. I don't know if I did a good job of really fundamentally breaking this stuff down. I hope I did, but we must always remember the relationship of PCPs versus who is in charge. Because remember, I could have a 365 demand PCP, but if markets have given me an imbalance, making my PCP valid, I'm looking at myself, so looking at the camera, I apologize. Look at making myself, you know, making the PCP valid, but markets get to a valid big supply, like a daily supply, a weekly supply, a governing supply. The force of hell coming from that supply will normally outburn a PCP. So what's a PCP good for? A PCP is good for taking a trade if the trend is still continuing. It's in the name, potential, continuation, pattern. So I don't like to take PCPs if who is in charge has changed. If it's a 365 demand, I am going to take it if markets haven't gotten to a supply. So if markets are going to retrace into a 365 and then continue to that same supply, I'll take it. But if markets are now coming from a supply, there's a change of hands. I kept talking about change of hands. Sometimes in class, I'd say the money, who's got the money, who's in charge of the money, who's controlling money. Don't forget that. Right, after we kind of like opened Jack in the Box here with the PCPs, we started flying through these areas of value, right? Complicated 365 candles was the next one. Also a PCP, right? And I'm just rushing here, guys, because obviously tonight's class is about deeper take on risk management. But you will know that complicated 365 candles, same thing with 365 candles, same PCP problems. We know the rules, we know the define of a trend. Those are characteristics of price. All those kind of things apply. Number 4, Talitha area, supply and demand. Number 4, right, your ranges, the consolidations, also PCPs. And then number 5, a special type of supply and demand that is extremely repetitive. You find it everywhere and anywhere, and you can have more than just one take on the area of value, was our turning points to be specifically different from major turning points. This is the crust of the course, right? I hope, I really do, guys. I fundamentally pray and hope that this has been utterly clear. I really hope that this has been clear. It's not to say you are now a master or guru. It's just to say, if it's your first time coming across this information, that it wasn't an awkward date with it, right? That there was some type of connection, that you're starting to see markets just a little bit differently. You might not be taking the best trades in the world, but upon reflection, sometimes you might need hindsight. It's becoming slightly clear what on earth is going on, right? Then we did a lot of things. We did a lot of charts throughout the course. Every time we looked at a new supply and demand, would break it down, etc., etc. The last big chunk that we did, after all 5 supplies and demands were clear, basic, and well understood, was the fact that we started to break down how to build a trade idea. How do you actually construct how to build a trade idea using smart money concepts, right? How to build a trade idea, right? How do you actually go about doing that? And we agreed together that the only best way to is multiple time frame analysis. And I was honest with you guys, there are many types of supply and demand techniques. I like institutional supply and demand. And because of that, there's one specific way we do MTA, multiple time frame analysis. We spoke about the golden thread that money flows through, right? So these is literally where we are. I mean, I know we'd get distracted once in a while and get lost in Bitcoin and crypto and news events and but if you're writing down a checklist and you want to find out if this course was worth your money, you need to figure out if you are okay here. So what I want to add now is what we did last night, which is to understand business partnerships in the markets with our brokers, the right brokers, which books brokers put you in, why they put you in that book, algorithm trading, what it's looking for, which I've explained throughout the course when I keep repeating myself that if they want to sell, if the banks want to sell, they'll create buy market conditions and vice versa, right? So this has been kind of like an ongoing topic nonetheless. And tonight I'll end module 1 with you as we talk about correct leveraging, risk management. And I'm gonna add, even though it won't be a long class, it's very important we talk about this part, how to grow a small account. Now that you know all of this, this is what I want us to look at tonight. Leverage, risk management, how to grow a small account. I say small account because retail traders generally start off with very small accounts. In fact, my definition of small account from a professional setting and what retail traders use is very different. Retail traders actually enter the markets with tiny accounts, right? Very tiny accounts. A small account in the market is anything below $20,000 US. That's a small account. right? 10,000 US dollars, 20,000 US dollars. That's fundamentally a small account. Retail traders with past regulations and also just trading, just trending. People thinking it's a magic pill. I've seen people, we've just seen, data points to with the brokers I spoke about last night. Most of them are reported. Most accounts start off with 100 to 300 US dollars. And I think the idea is rather start off with something small that you can lose and that would be okay. That's terrible investing advice, but good trading advice. But you never, whatever you focus on grows. Wherever your attention in life is, whatever you put value in grows, right? So I suspect if people actually put in serious hard-earned money into their trading account, they'll be more meticulous with risk management, but it's just an assumption, right? But of course, I know that there are some people like brokers who start off with something as small as $15 to $20 and chase bonuses and all that kind of stuff, which I always advise against, right? So this is where we are today, leveraging, etc. So I'm going to quickly talk about leveraging risk management. Can we simply take PCPs for a resting place when on a journey where you get to rest as well as refresh before? Yes, Alan, absolutely. As long as you haven't arrived at the journey. I think that's a perfect analogy. Alan has put something there on the Zoom chat. As long as you haven't arrived at the journey, so if the destination is still up there and the PCP is here, then you jump in. But if your journey is complete and you've gone to your destination and you're now coming back from your destination, then the PCP is not a safe place to rest. Right, fantastic. Okay, cool. Risk management, the joys. The one thing that traders generally don't care about, because they have told themselves they're going to become multi-billionaires. Right, by the way, today FOMC minutes will be shared at 8 p.m. So while we're still in class, an hour from now, and I'm pretty sure the dollar is going to dance, and then this nutcase is going to talk. I'm pretty sure Brainard, if you listen to what he said about 2 days ago, I'm pretty sure he's already started selling stocks. But I'm not so sure if tonight's CPI indicator gave him what he wanted, right? But this is interesting, because if CPI was positive, then yeah, again, a little bit of an alert for inflation, but we're not creating that. America is not creating that many jobs, right? Negative NFP on Friday. So it's going to be very interesting to see what the minutes say, but the minutes are historic. So the main thing here that we're waiting for now is FOMC to let us know. But yeah, those are very fascinating read. Obviously, I was just catching up with CPI. This is actually a good website for statistics. So and they generally try and release stuff on time, because today I was stuck, man. Forex Factory lagged for about 2 minutes, so I couldn't really jump on the action on time, which is fine. But I noticed that these guys popped the results of CPI like within like 10 seconds just before 2:30, and I should have had them on in the first place. But what they then do is they actually break down everything that was. So I was going through it, what foods went up, what industries are going up, etc., etc. That's fundamentally important for someone like me who also trades stocks, right? Because I want to see where to kind of like move stuff around. Yeah, so it was nice. It wasn't nice. I mean, I don't really care for it, but it happened. Right, so what happened with CPI, since we're still on the charts, since we're here, anyways, we're here, because I like I said, I've just dropped a YouTube video on my live commentary on CPI, but let's do a proper analysis on this stuff. Markets were always in a supply. I mean, I feel like I repeat myself, but I feel like to traders, it always sounds like new information. But it's not. It's really not. And I don't know if you guys saw this on the public Telegram group, right? But I took time in the morning before power went to draw every single CPI historically, right? So I drew them, and there was no time to announce, because then it was not time for me to take my nap, because then power left. But oh, what did I woken up? I don't even remember. But look at this. CPI was positive on the 12th of May, like today. When I say positive, I mean the expectation was 0.3%, but we got 0.4%. Or I hope you guys can see that I'm sharing, yeah, screen 3. Right, so I simply clicked on this folder, And then I looked at the history of CPI up until May, and I was like, okay, fine, let me back test CPI for the last 5 months. A better back test would have taken account for a year. You want a year. I should have looked at CPI up until September 2020, but time. And again, for me, I've seen this a lot of the times. But you see that there were 3 positive CPIs, 1 neutral where nothing changed, 1 negative, and then obviously with today's one, another positive one, right? So now I've got 6 CPIs, and most of the times 4 beats, 1 neutral, 1 loss, right? So I obviously I just looked at the 5 from May. Markets were positive on that day, but where was price coming from? Guys, like that question I've asked almost in every class. And if you catch yourself trading before asking yourself that, you're gonna be in trouble. You're gonna be in trouble, right? So look at this. So markets on the day of CPI, on the daily time frame, for me, you know, moving towards this demand. This is it. I'm back testing. I'm proving my thesis. I'm literally learning price. I don't want any surprises, right? So have not yet arrived at the demand, but are about to get to the demand. And then someone, obviously in the senior trade academies, a quick meeting the early hours of this morning when power came back after 7 a.m. Spoke about how there was a demand day, and I agree that there is a demand day. I agree, but okay, I was going to show you averaging candles, but it would just be too much work, right? So there was demand there and markets exploded up, right? So markets exploded up because of the demand. Markets exploded up because CPI was positive. Markets exploded because of the demand in CPI. Doesn't make a difference, right? But where was price coming from? Markets had created a big supply. This was my favorite supply of the DXY chart for about 2 months. From FOMC, June, July, August, the supply held down things for me, right, all the way there. And I spoke about it a while back. There was a market gap, right? So it was quite a strong supply. So long story short, markets continued down. News events do not change the trajectory of price. Anyone who will tell you that fundamentals move the markets, and this is what they mean, you must ask people what they mean when they say that stuff. But if they mean a fundamental news events will change the direction of price, they're talking utter crap. How does the data release that came out 15 minutes ago change net positions, order flows, order blocks that were put in price 3 months ago? If you read the COT report, every Tuesday, there's more orders being added or less orders being removed. You can't change the direction of price. You can get a 1 day, 2 day reaction, but it's not going to change. And I'll prove it to you. So this CPI 1 from May, positive, but the downtrend continued until markets bottomed out. CPI number 2, is positive on the 10th of June. Now that we finally set at a fundamental real demand over here, which I'm pretty sure if you do this, right, you can see it's bottomed out on the weekly time frame. We really found the actual bottoms. On the weekly time frame, it would look like this, right? Look like that. Fresh touch. We're doing the retest now. Okay, hope you guys are with me. I'm moving a bit fast here because it's not what we're supposed to do tonight. But there we go. CPI index is moving up, and it happened to be positive. Great stuff. On the 22nd of June, complicated 365 candles show up and a beautiful imbalance show up. And then where do markets go? Markets rally up, come make contact with our demand. Let me remove this arrow. '13th of July, somewhere here. So I just want to reduce it so that it's not in the way. Right? There you go. And if you draw your area of competition, whether you want to use this week here or whatever floats your boat, markets did come the first day, I think on the 6th, then come back, rally up, bounce up, continue up, make contact with the supply, close the gap, come back in. And this is what we're talking about there when we're doing our recap, is that these PCPs for me are very risky when markets have changed hands. Markets have now changed hands on a supply. Sometimes it works, sometimes they don't. We don't like trading sometimes type of things, right? We want to trade stuff that we're sure of, but it looks like it's going to hold. The reason why it's going to hold fundamentally is because FOMC on the 16th of June has promised rate hikes, right? I hardly ever forget FOMC meetings On the 6th of June, there was an interest rate hike promise that we're going to get interest rate hikes a little bit earlier. So markets ready back up the supply and take it up, right? So this area holds, right? It's got a positive CPI reading. It's somewhat of a strong demand, and markets are using it as a tennis court to bounce from supply to demand, demand to supply until the supply pops. CPI on the 13th of August, you see here, 13th of August up here is unchanged. It's this one here. There was no change. It didn't go up, it didn't go down. It maintained the focus. So it's, whenever you get something like that, markets are like, yeah, okay, fine. No good news, no bad news. What's structure gonna do? If you look carefully, on the 13th of August, markets rallied back into a supply inside a supply. This is the second yellow zone. I'm saying you see, guys, because I trust you see. I'm saying you see because I trust you see. If you don't see, you gotta talk to me on the chat box there. All right. So markets on the 13th came back to this massive bearish engulfing pattern, which created this beautiful sell-off. Markets coming on the 13th unchanged means there's nothing to rally on. So there's no real good news. There's no bad news. So what's going to happen? Structure is going to take over. So we get 1, 2, 3, 4 days of selling because we're in a supply, even though we're about to go up. Why would we go up? Glass effect. Boom, that's your mind. All your module 1 rules are working. They're working. Right, and then eventually markets break. So that's unchanged. 11 or August, and then markets, the next CPI is the next month. After NFP, you get CPI all the time. Right, now 3rd of September is NFP. You see here where I am? 3rd of September is NFP in September. NFP was terrible in September. Markets were in a demand nonetheless. Talitha area, base, rally. See that there? Right, and then markets go up. Markets go up, markets come back in. 14th September, what do we have? CPI. After NFP, you always get CPI. CPI, I think, was negative. You see this negative? Look at the candlestick. I can drill down. I mean, I hope you guys have trust because I have to move on, but I can drill down to 5 minutes. Because CPI was negative, markets actually fell. You know what? Let's drill down. I don't want you guys to ever say he's making stuff up. 13 September, was it 13? What's the date we're looking for? What is the day? 14 September. So let's go to 14 September, 2:30 to find CPI. Because CPI was negative, I can guarantee price fell. But when price fell, it fell into a demand. 14 September, 2:15, 2:30, CPI happens, markets fall. That's so when you come to the daily time frame, what you're looking at is this. You're looking at this short, skinny, not short, but very long, very skinny wicked candlestick, and that's because it's when CPI happened, markets plummeted down right into this area of value right there because it was a negative CPI, but fell into what? Into a demand, right? So you get negative CPI, and this is what really plays with people's minds is they want to trade the news event and forget that, okay, who cares that CPI is negative? I'm a multi-billionaire. I own 15 banks. It's an example. I own 15 banks. If all 15 banks of mine have put $6 trillion at that level to buy DXY, what do you think is going to happen? Right? The demand was created for NFP a week ago, 2 weeks ago, whenever, on the 3rd of September, as a reaction to a demand which existed on the 29th of June, which was sitting on a demand that existed on the 22nd of June. So this is where dollar bulls have drawn the line. I mean, you can actually see them. They've become territorial. In module 2, next week, when we start to talk about supply and demand curve, the curve, right? You will see that once in a while, the bulls and the bears, supply and demand curve is a tool. Remember, my module 2 is about tools. I'm going to give you a tool to assess these things. The bulls and bears, they become territorial on our charts, and they draw the line that this, we're not crossing over here. Price isn't crossing over here until we are ready for it to. It can play inside these zones, but it won't cross over, right? Because we have an agenda. We're going up. Don't forget, DXY, since Biden came into power in December, has been trying to leave a governing demand. Never forget that the only person in charge here is a governing demand, right? I had to zoom out a lot so as to kind of like not squash out these words, right? But I want you to see this. I'm on the governing time frame. I'm on the governing chart here. This is a demand. I'll show you. Look left. Look left. This is what your DXY looks like on the monthly. We're inside a demand. Markets are inside a demand, making their way surely to a supply, maybe, which is about to get broken, but price was leaving a demand. So again, dollar bulls are in charge. You see, my course is nice because you actually get to see the whole mechanics of markets. But I think traders forget this stuff on a day-to-day basis. That inside or every day, buy, sell, you see so much buy, sell, you forget that at the end of the day, no matter how many times you sell DXY, and I sold DXY a lot. I was a dollar bear a lot because I naturally, I'm pro crypto, I'm anti-fiat. So if it's time to sell the dollar, I feel like I'm fighting for the cause. I'm fighting for the crypto cause. I'm pushing down a currency. I love that stuff. But I never forget the fact that the governor is in charge. This thing is going up. So this is clearly for me a bullish territory area. CPI is negative. So if they want to buy something, they'll create conditions for you and me to sell it. CPI is negative. People sold into demand. Markets bought against them. Trust me, they did. Boom, markets exploded. And then we are where we are today. CPI positive. God, man. CPI is positive today, but where the hell is the dollar? The dollar is inside a supply. Right, so I can show you, again, 15 minutes today at 13 October, the cute dollar reaction to a positive CPI. So, and you'll see in the short video I did 15 minutes, I used USD CAD. I was like, okay, fine. Before CPI dropped, 5-10 minutes before, USD CAD starts to explode up. I'm like, oh, God. I wanted to buy EURUSD. I wanted to buy EURUSD because I was thinking probably CPI is negative. Thank God I didn't, right? Because CPI was positive, so that would have been a terrible trade. And I was going into quite a big lot size, but you're gonna see in the video. Anyways, the point is, I started to talk to you guys about the fact that I'm watching. I watched 3 charts just before a news event. Doesn't matter what it is, NFP, I keep it to 3 or 4. And I normally just trade 2 because even though I've got all these screens, I have only 1 mouse pad, right? And I can't think that fast. So I want the opposite. I open a USD. If it's positive, I'm going to buy USD and immediately sell EURUSD. And I always have one index, right? So I told you guys at 7, I'm going to sell Nasdaq stocks and I had a pen in order for that short-term drop. And that's it. I keep it simple, 2 to 3 charts only. But there it is right here. That's 2:15, 2:30, CPI news drops positive. It is positive. I'm on the 15 minutes time frame. And then the dollar rallies. Now look at this small chart, because remember we spent so much time on big charts, daily, weekly, monthly. Look at this. When I say the stuff I teach you, you see this secretly, quietly, just chilling there. Once again, everyone in the whole wide world is focused on the news event. The news event is saying CPI is strong, dollar is gonna grow up. Look at where it went up to, a 15-minute supply. Look at this textbook stuff, guys. This is you know this stuff. Tonight is our graduation from module 1. You now know this stuff. Can't just be me seeing the stuff like, okay, fine, it's a short term. I tell you guys on USD CAD, that area of value there that we bought at, that markets exploded from, don't come back again. It's weak. It's weak because, first of all, our areas of values, rules, but more importantly, the markets have made contact with a really fresh, very looking, this is a seductive looking supply. It is a supply literally just chilling on top of a supply for backup. I mean, you can literally draw it like that. It is pretty. Look at the imbalance. There is conviction from the sellers. Not even a single green candle. It is a selling territory. And where is it in multiple time frame analysis? When it comes to multiple time frame analysis, that little 15-minute supply all the way there is inside a daily supply. What more could you want? A daily supply that's only giving you a fresh touch and is now giving you the retest of your life. What more could you want? What more? It's a textbook trade. So what do I, it's your accounts, your money, is not much I can do. I'm going to show up for the next 10 years in your life, make content, keep creating modules, and hope to educate as much as I can. But it's your life. But I think at some point, by the time this year is over, right, because I've never really felt the need to cover news events, but now I am quite a lot. But I'm hoping that by the time the year is over, I can just go back to happy trading, pinned orders, long-term, create more swing traders like me. That's what I want to do with my life, right? But I'm hoping that by December, guys, we can all agree, where's the money? Where's the money? Is the money here? Is the money opening your risking your account for no goddamn reason, over risking, taking a big lot size just to catch a 0.2% difference? This is literally less than 1% change in the DXY, this upward movement. That's because for you to make money in such a trade, you have to use a big lot size. If you see how they trade news event, they use big lot size. Or is there money in simply trading supply and demand? I mean, a daily supply, multiple time frame analysis, daily supply, H4 supply inside the daily supply, H1 supply inside the H4 supply inside the daily supply. Oh, look, there's a perfect 15-minute supply. What if I let dumb traders buy up, right? I actually missed the buy. Sorry, I was not in this trade because of the delay of Forex Factory. But I walk you through it, right? I was just in a Nasdaq sell, but I walk you through where I would have bought and why I would have gotten out right now, because this is dumb money. This is like an explosion. They want to sell, they'll create conditions for you to buy. Markets pushed up. Where's the money, guys? That's a 0.2% change. Since then, this is what has happened. Double. There's the money. We're dropping again. Why are we dropping again? Because we're still in the supply. If they are strategically weakening the supply, but the supply is not broken, right? I don't remember why we got here, but whatever reason it was for me to come back to the charts, it was well worth it. Let's talk about risk management. Today was another textbook day for us. And this is, I'm doing this because, again, in my heart, you guys, all of you are supposed to be graduating with cum laudes on this stuff. This is the stuff that I want to talk about. Right, let's talk about risk management and let's talk about its importance. You are not a trader if you don't understand risk management. You're a gambler. You are gambling. And with gambling, it's nice. Gambling is fun, apparently. Anyways, I've never gambled. I once went to a casino with my partner because it was like the biggest highlight in Queenstown. My partner is born in Queenstown, and we went there to have supper. I don't know whether it was my birthday or her birthday, and it was noisy. I hate such. I'm not like I'm not a fun person. Those of you who don't know me properly or personally, I am a very boring individual. I'm a very, like, I don't go out, I don't drink, I don't smoke. If you want to have a good time with me, you sit next to me and we both read books in silence. That's a bloody good time, right? So anyways, without risk management, you're gambling in the markets. You are gambling, but you won't understand risk management if you don't understand leveraging, if you don't understand the deal that your broker is going to give you, which is what we started talking about yesterday. So if you've never traded before, this is an important concept. If you've traded before, it's something that you need to understand. All trading will involve leverage. And it was in your guys' intake where I said, just imagine this is a superpower. Leveraging is superpower. Superpower is to say, I got $100 account, but damn it, man, dear broker, give me a superpower so I can trade and transact on a level of $1,000. What about 10,000? Can you give me that power? They can. You literally can with your account. That's what leveraging is. It is to give you a false identity. You know Superman. What's his name? Something Clark. I've forgotten. Tony Clark. Tony is the Marvel robot guy. I forgot it. Whatever Superman's name is. He's got the glasses during the day as a reporter, and then at night he is Stark. Yeah, Clark Kent. Thank you. Oh, Sheila, I actually wanted to private message you and say, I don't think I forget stuff. I don't forget. I just never have time. But Sheila, you remember that this is something that you wanted me to redo at some point with you. So I wanted to ask you to come to class tonight, and look at you. You're here. Well done.
Yeah, thank you, Leroy.
Yeah, I felt bad that I never came around to fix it, but let's fix it tonight. Let's fix it tonight. Right, fantastic. Cool. Right, yes, and Mr. Kakoma, Tony Stark is Iron Man and Clark Kent is Superman. Right, so those are real heroes, quote unquote. I'm a Marvel fan, but come on, man. Tony Stark is not a hero; he's just a rich billionaire with nice toys. Right, so Superman from DC is Clark Kent during the day, and Superman when there's problems. Your broker will give you that feeling of you're a superhero, but he's not. Leveraging, allows you to buy a lot and to sell a lot in the markets. Awesome, more than your account has. But guys, the same measure that you do unto others is done back to you, right? It's the exact same principle in the markets. If you are wrong, you won't be wrong at $100 level. You're gonna be wrong at the superpower that was given to you. So we must understand it. Now, I did a cool one-on-one a while back, which is on our YouTube channel with a nice guy from Zim. He's not in the academy, he's still trying to get his stuff together, but he didn't mind me posting it. And the one-on-one was just to see where he is. I need to actually follow up on him. So I don't forget, I'm going to make a note here to see how he's doing, to see if that advice actually ever helped, because that's quite important. Right, and the nice thing about it was he was trading on a micro account, hoping to grow it. And a micro account is an actually smaller account than a standard account that some brokers give you the option. So a micro account, you literally just trade in cents. And the idea is, well, if you lose really a lot of money, and absolutely you can blow micro accounts. You can blow and keep refunding and lie to yourself and think it's more money. It adds up, number one. But number two, the damage of micro accounts is less in how much you lose, but it's in the financial muscle, the muscle you're doing, right? It actually creates a terrible trader in you, right? Because for you to make a lot of money in a cents account, in a micro account, you have no choice but to over leverage. Otherwise, you're literally holding price for 3 days just to make 5 cents. And the only way you can make $5 is to use a big lot size. When you feel like you've graduated from a micro account, I promise you, traders can't just shake that bad habit. They go in hot and they lose a whole lot more, right? My general style of trading, my general style of fund manager, the clients that we have managed to keep, or not keep, because I decide if I want to continue with you, not the other way around now. But the people that I've worked with for more than 3 years, corporate wise, understand this about me. I am never looking for a quick fix in the market. I like risking as little bit as possible to make as much. I am literally a leprechaun in that way. I want to spend the least amount of gold for the biggest pot. It's unfair, it's borderline greedy, but it's safer. It's 10 times safer, right? Micro account won't do that. So the first thing we need to do after yesterday's lecture on brokers is we all need to start off on a standard account. And it's up to you. You can open a micro account and see what I'm talking about. But tonight's lecture is going to be on standard accounts, because standard accounts have a principled, structured way of how leveraging works. Now, leveraging in the markets will make more sense if you understand what on earth you're buying or selling. Every time you open EURUSD, you press buy or sell, buy or sell, buy or sell. What are you buying or selling? Did you guys see I told you guys about falling wedge on EURUSD during the day? And I said, if you want to take it, you should take it. You saw DXY is falling. You guys, I don't know if you guys read all the stuff I send in the public group, but I don't send a lot. You saw DXY is falling. It's just a random thought. I saw price compression in the morning. DXY is now falling. So what do you think is happening to EURUSD? I guarantee right now, EURUSD is flying. I guarantee this is happening right now. I know, I was talking about leveraging, and then my mind did this. This is why I write stuff down on the whiteboard to slow down my thought process. It's the nice little gift God gave me. Supercomputer. I'm joking. You have to develop your mind. Anyone can think however they want to think. Just keep reading a lot of books. Right, this is EURUSD on the 15 minutes chart. To me, it looks like it's exploding. Let's go to H4 to see it better. There we go. Bullish engulfing pattern, exploding. Let's go to 1 hour to see it even more better. Right, this is what I was talking about. I think I drew on the H4 time frame. I cannot remember. Right, all you see is green, and that's because the dollar is weak again. Why is the dollar weak again? The dollar is leaving a supply. Something like that. I mean, it could be cleaner, but it's not. It could be cleaner, but it's not. Right. So when we spoke earlier on during the day, and I was looking at this thing, I was looking at how price was reacting. It was probably somewhere here before CPI. CPI was negative, positive today, so euro fell. This is a CPI candle. Straight after it fell, all of a sudden markets were back in balance. Massive, this big candlestick here. A green big candlestick next to a red candlestick, that's called a bullish engulfing pattern. That is a lot of buy activity, push price the hell out of there. Now, this is literally what we've been waiting for in the euro. If you're like me, I want to sell the euro somewhere up here in this red zone on the daily time frame. I'll cover this in the next war room that's going to drop tomorrow or today, depending on electricity, right? I don't know. Markets could stop here. I don't even want to lie to you. This could be it, the end of the road, and then price starts to drop because we had complicated 365 candle. But I don't like the imbalance. If I don't like the imbalance, I'll allow markets to eat without me. I won't go, what if price leaves me? Oh my God. And then I won't be able to make money, because that makes sense for an amateur trader, or when you're still mastering yourself. That argument makes a lot of sense. Let me sell now. This kind of is a supply. It just kind of didn't give us a good imbalance. If you kind of think about it, you can go 1, 2, 3, and then there's kind of like an imbalance, or 1, 2, 3. All those kindas is you convincing yourself to make a terrible decision. And then the thing is, but if I don't take the sale, Leroy, how am I going to make money? How am I going to grow the account? And then you stop thinking there. The thinking process dies right there. Well, here's another thing. What if this kind of doesn't work? What if you just kind of wait for the kind of supply that kind of makes bloody sense, right? Which is the one up there. So you kind of want to see a setup like this. You actually want euro to be strong. I wish you strength, dear euro. I wish you love and strength. I wish you keep going and going and going. Well, probably here to start my area of competition. Even though I know my reasonable body is somewhere there, area of competition is there. I want to get in early, because on my corporate accounts, remember, I told you guys weeks ago, I am not buying euro again on corporate accounts. We are officially selling, and that was it. It's there, September. I've been holding these sales, so I'm not too desperate. This area of value, you'll see us in the water. This one is the only daily supply in confluence with the weekly supply, multiple time frame analysis. So I put my blue line there. I'll show it to you. Just remember the blue line. This is important, because I honestly, literally, I'm giving out free signals to build a trading community. It is one of the worst things doing, creating signals for people, between you and me. I'm being honest. But I know people need money and need to make money, and also need to test things out and actually see it work many times. But for me, I'm just using it as a way to build a strong trading community, right? But look at this. There's the blue line. Let's go to the weekly time frame. It is the only confluence. Do you see what's happening now? There isn't not a single other area where this is what I mean. See this there? Weekly supply, the blue line. Complicated 365 candles confirming a downtrend and then dropping. This is the only confluence. So that means now euro bulls might take over, but it might be short-lived. I would not be surprised if this happens. Why? There's so many things in the way, which makes trading more exciting and tricky and annoying, because now you need to decide for yourself, well, how long will this last? How far will the dollar fall? Will the dollar fall all the way down there? And if the dollar falls all the way down there, what's the distance to the euro? Is this the distance to the euro? Can't be the first one, at least I don't think it is, right? But this might be a much more natural course, right? Then when the dollar gets to that demand and I'm triggered into my supply, I go. Why do I want to get into more euro sales? Because my governor is bleeding. My governor is bleeding. For those of you who are scared, you exit right there. Why do you exit right there? It is the only valid daily demand left on the euro chart. This demand was broken. This is the only one. You guys get this? Sorry, I jumped from leverage to this kind of stuff. It's just that I remembered telling people to take the euro buy. I mean, I said it in different ways, twice. Said it earlier on, and then I came back and said, look, I might not be with you in this trade, yada, 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 yada. And I'm pretty sure I got a pending order triggered, even though I say such things. Then I go back and go, why would I leave money on the table? Right. I'm not lying. I know traders lie. I know people always lie and act like they take trades all the time and they every trade. I'm not lying to you. Here's EURUSD on my live account. I'm just doing this just to put it on record. Right. I'm not lying. There's my buy. There's my EURUSD buy. Compression. Right. I was triggered at whatever time this was earlier on today. right? And there's the compression. See that there? And where's my sell? The one that I just showed you now on the daily time frame, right? There's a short-term sell there, a big one on the 1 hour time frame. So I'm just literally riding the wave. I'm risking like $10 to make 100 if markets get up there. That's $100. My stop loss is about $10, $20. 1:10. But yeah, that's the last time I'm going to get distracted in this class. It's just that it's important you see me do this stuff for real. It's important I talk theoretically, I talk mindset, and then I show you the practicalities of it, because the stuff repeats itself. And after class, if it's still going up, I'm gonna break even. I refuse to take a loss. I'm gonna break even. If markets change their mind in the middle of the damn night and come down, they're not gonna find my capital just waiting for them with its legs wide open. I'm gonna break even and go to sleep, which means I've got 2 trades, 2 buys running there. I'm gonna make $200 risking 0. Simple trade, right? But euro, I really want to sell. That's why it's small lots, because I'm counter trading. I just want price to go up. I'm just helping the movement get to my supplies, right? What are you buying and selling in the markets? I'm back to the whiteboard. I promise you it's the last time I'll get distracted, but I hope the distraction's out. Euro buying and selling in any trade, in any charts, forex specifically, stocks, we know we're buying stocks, crypto, we're buying crypto. But long story short, you are buying units. You're buying units of the asset. Units. The units is what you're buying. You're not going to actually be transferred euros into your account. You are buying equal units, right? So what brokers will do is they'll give you a system called lot size. Lot sizes is how you power up your account, your superpower. The stuff that you see us talk about, 0.01 is a lot size. 1.00 standard lot size. You can go crazy, right? That's that is it. This is the equation a broker is going to use to work out how much profit you make or how much losses you make. The lot size is what they're going to use to calculate against your capital. So they're going to pay you in pips. So every time markets move in your direction, so let's say you buy Euro USD at 1.2001, and then Euro USD moves to 1.2002. Ding, 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 ding. You are in profits. How much profits are you in? Well, it's called a pip. You are in 1 pip profits. Price has moved 1 pip forward in your direction. If markets actually did something like this, 1.000, ding, 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 you are now at a loss. How much loss? Well, price has moved 1 negative pip against you. Right, and then what your broker goes is, well, that's not enough. We need to know how much superpower you use. Did you say, look, man, I'm going to stick to 0.01, which is the smallest amount you can use, which will affect how many units you're buying or selling of the currency? Or did you go, you know what, I actually think I'm going to go big time. I'm going to use 1 big standard lot size, right, per point. And then the broker will be like, 1 pip times your lot size is going to be equals how much you made. So how much you made in general, right? So I hope that's clear so far, because you need to understand this is the business side of trade. I actually hate calling it risk management. So because we're talking about standard accounts tonight, I want you to know this. In a standard account, remember we start off with 0.01. That's the smallest lot size. But in a standard account, 1 lot size, 1 lot, 1.00, 1 lot basically equals 100,000 units. All right. In a standard account, 1 lot size basically equals 100,000 units. So every time you buy Euro USD and you decide to use 1 standard lot size, this is how much you're buying. So you can imagine now why banks make money. I won't lie, at the beginning of COVID, my little brother, one of my little brothers anyways, with me in Grahamstown, just finished his master's degree. And I'm very proud of him, but he's now moving to Joburg next year to do his PhD in global value chain. So he's a global value chain specialist. But outside of that, that guy is just a hustler. I try to teach him how to trade. So I've got, he literally follows me. my little brother. And I've got another little brother, the 19-year-old, who's actually like full-time trading now. And I'm trying to get that boy to come back to get into first year next year. He's done with high school, he's in a gap year, and he's just trading his brains out. But if I lose him, I'm going to lose him to the markets. He might not even want to go back to varsity. Long story short, my little brother with a master's degree started, when COVID started, he gathered a whole lot of contacts. And he figured out that a lot of people who were going to need to start supplying face masks. I think they were called PEP at the time. This is like last year, March, like literally at the very beginning of COVID, before we even knew that lockdowns could be possible in a democratic society, right? Which again is a big fallacy, democracy, whatever. He started to figure out. So he explained how it was, but basically he needed to get about masks in bulk, but the masks were like being sold at about 35 cents and rands, 35 cents, 50 cents, 1 rand, like very silly, stupid prices. But the reason for that was because these people had to buy these PEP masks in bulk. So his orders would be about 2.5 million face masks, and he would quickly go supply hospitals. It's just like all over the place with this kind of stuff, right? So you're buying 2.4 million face masks, right? And you're buying them, technically speaking, about 35 cents per face mask. Now, if you go anywhere in town in South Africa, and I'm sorry, it's a South African example, you will know that face masks are anywhere between 20, maybe 15 to 20 rands. And then they're actually the fancier ones that might go up to 40 rands. But do you see the interesting scenario here? The problem, not the problem, but capitalism, the nature of doing business smart. This is the mindset of a trader. He's not a trader. He trades when he needs money. Like all of a sudden, you'll see him opening charts and trying to navigate stuff, and then you blow account here, make money here, because he's not consistent with it. But this is his thing. He loves projects. He likes getting his hands dirty. Blah blah blah. But do you see this? He's buying face masks at about 35 cents. But when I go to buy the same face mask somewhere on a shop, in a retail shop, or on the streets, whatever, I'm going to pay 15 rands for the same face mask, which I now know at the back of my mind is actually only 35 cents. So this is what we're doing in trading. We are buying massive units of currencies, right? And what our lot sizes do is we figure out how low or how high we want to buy them, as long as we're going to sell back the same things we bought at a higher value. This is massive, massive, massive gross profits. Massive. Buying something for 35 cents and selling for 15 cents. It is a big return of investment, right? Eventually he was bullied out of it because a little kid, and these other corrupt guys took over, blah blah blah, but he had fun, right? Long story short, same thing. You are using a standard account. One standard lot equals 100,000 units automatically, but you can toggle that to suit your account. So the minimum you can ever go is 0.01, which will actually affect the amount of units you can control. A standard lot size 1 means you can control 100,000 units. So you can imagine if you open a trade with 2 standard lot size, you can control 200,000. The math is quite basic and simple. Now, looking at that, how do I want to play this? Do I want to play this with a smaller account? So let's start off with a bigger number so that we can all understand. Now, with a standard lot size, our pips, remember I said everything moves in pips in price. Pips are worth something, and you need to figure that out as quickly as possible. But it's going to be based on the lot size that you choose. This is a basic, pip range. It can go on and on and on and on, but I just want you to understand some basic stuff here. Right? On one standard lot size like this, controlling 100,000 units, 1 pip is worth $10 US. Let's quickly go back to my example. I said earlier on you bought EURUSD at 1,2001, and then markets move. By the way, pips are covered with the last 4 decimal places of price, with an interesting difference with yen pairs. We'll talk about that another time, right? And then did I say let's make this 0, and then let's make this 1, and then I said you bought it at 1,2000, and the markets moved 2001. It means at the end of the day, price moved 1 pip. Well, that 1 pip, if markets moved up 1 pip, you bought it at 1 pip, it actually means, Mark, you have made $10. So if markets move 2 pips, you're gonna make 20. If market moves 100 pips, you're gonna make 100. You know what I mean? 1 pip is worth $10. But let's say you have a small account, and I'm gonna define what that means. And you can only use, if you're trying to be smart, you can only use 0.01. Well, you need to know that 1 pip change will be worth 10 cents. So this is the interesting part about traders and the war room and signal service and forex traders and forex signals and a lot of things that people don't get or understand. A signal service provider, a good one, an honest one, and there are very few of those, but most signal service providers or people taking the signals, let's not blame signal service providers. Those guys are just hustling and doing their job. Let's talk about people taking signals. You forget that that person, first of all, you're not even in charge of the trade idea. You don't even know why they're telling you to buy or sell because you're just chasing signals. You don't understand the rationale. You don't know if they're going to be in it for real. You don't know if they're a terrible trader, but good with analysis. And so maybe they can predict price, but they don't take trades because of FOMO and they exit too early and they don't want to sabotage their trading business. You don't know a lot of things about your signal services. But the most important part is if they show you their accounts or they tell you how hard they are going, people forget this. My lot sizing as Leroy in the war rooms and your lot sizing as the trader has to be linked not to the perfection of the analysis, but to your size of your capital, which is to say Leroy on EURUSD can make $10 because price has now moved 1 pip. In fact, right now I am in the trade that I told everyone to take if they want, and markets have moved exactly 26 pips since 7 p.m. So for the last 46 minutes, it's now 7:45. For the last 45 minutes, price has already moved 26 pips. All right. Right. So now, if I've taken a buy, which I did not at 1 standard lot size, I use 0.10. I use 0.10. Even better. This is a perfect example. I use 0.10 right here. So 1 pip, I'm making $1 for every pip. So if I calculate my spread, because I have to remove my spread from that, I should be making anywhere between $22 to $23. I should be in profit by $22 to $23 right now, roughly. If I remove spread on EURUSD or on the broker that I'm using, right? I hope so far. I hope that makes sense. But if you took the trade on $100 and markets have moved 26 pips, 25 pips, and you're using 0.01, you need to remember that 1 pip change won't be $10 like Leroy, or $1 more specifically, because I use 0.10 on one of those trades. For you, it'll be 10 cents per pip, right? So you might be up $2. And then I come to the group. That's why I don't even do that stuff anymore, because it just causes a lot of confusion. A lot of people who are so new to trading will start to think they've been scammed, or they don't understand, like, why do I have $2 and he has $20? Well, people actually ask these questions privately, literally, like, well, it's because our lot size is different. And then when you say that, I've noticed the next time I give people a signal, they are here. But look at this. $22 of $100. Let's say you got $100 account. It already means you're risking 20% of your account. If I lose $22 on a $6,000 account, I'm sleeping the same way I'm sleeping every day. On quick trade, this is commission. Every time I open a trade, they charge me about $25 on commission on a standard lot size. This is like the cost of doing business in my other brokers, right? This is not a big loss, but for someone with $100 account, that is 20% of your account. For me, if I lose this money, that is less than 1% of my account. Risk management. So what you need to do is to stick to your path. All right, so I'm hoping how we calculate this stuff is simple, right? So obviously zero, if I was to, this was the lot size I was going to use on EURUSD today if CPI had been positive, but you'll see it on the video, I filmed it on my live account. I wanted to make about $5 per pip because it is a short distance move and markets were going to bounce for about 50 pips, no, about 20 pips or so. So I was just hoping to bag something like that. I had one trade, one buy at this and one buy at that. All right, if that makes it a standard lot size. Now, how do you know the amount of lot sizing to use for your account? Well, I came up with a very simple mathematical equation. It's a simple one. All right, and it's this simple. For every $100 for every $100 in your account, if you have $200, that means you have $200. Does that make sense? For every $100 in your account, so there are 200s in 200. For every $100 in your account, you use 0.01. This, guys, I want to be the first person to tell you, is not sexy. It will never be sexy. You will never trend on social media using 0.01. This, however, is a lifeline. It is not my fault, your fault, or the market's fault if the account is small. If the account has to start small because you're starting, the account might have to start small because you have a lot of stuff to work on outside of trading, your psychology, for example, your schedule. You know, sometimes traders have a terrible schedule. You have to pick up the kids at 4. You have to drop them off lunchtime. You have to stay at home. You have to work part-time, full-time. You sleep at 10 p.m. doing a third job. You're so tired. You watch the markets glaze. If that's your life, which is a lot of people's lives, yeah, reduce your lot sizing. You're not focused, and that's okay. Maybe you just want to get this idea going of buying and selling, learning about yourself, learning about the markets. One day, when you make structured time for trading, right, then you can start to increase your capital, which will allow you to increase your lot size. It's not the other way. You don't start by increasing lot size to grow capital. No. Capital is built by process, not lot size. For every $100 in your account, 0.01. This is the mathematical equation. That means if I have a $500 account and I start trading with a $500 account, there are $500 in $5. So when I press buy or sell, I have these options. Number one, buy EURUSD at 0.05. Cool, gone. Or buy EURUSD 0.01, and then I saw something interesting in USD CAD, and I was very sure DXY was falling, leaving a supply. USD CAD was going to be a sell, so I'm more confident in that trade, 0.02. But I also saw that USD ZAR was looking like it was going to fall because, again, with dollar 0.01. But I think just to be sure, because pound moves like EURUSD, so if EURUSD is going up, there's a high chance that that demand on pound USD is going to work. I go in 0.01. You've got a diversified portfolio, but has your risk management changed on your $500 account? I hope not, because that's what you need to be very careful of. A lot of traders assume, well, let's do the math here. 1 + 2 + 3, blah, 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 nah. So that's 3, 4, 5. Right, so I'm correct. At the end of the day, you've used 0.05 out of all these 5 trades. Do not forget this. I've seen traders go, you say for every $100 use 0.01, and then they do that. So they'll take 5 of these trades. EURUSD buy 0.05, USD CAD sell 0.05. So this will be 0. I want you to see this. I want you to see this logic, because sometimes I'm lost for words. I'm floored by people's logic, and then I'm like, I have to be nice and kind, and I'm recording, and I can't say something mean. But this is it. People be like, yeah. So if I basically, this is what you say. And so, I mean, I won't even finish. I'm sure by now you can see how silly this is, because at the end of the day, already with just 3 trades on your account, you are now operating not at the rule that I'm giving you. You have risked now a total of 0.15. Do you guys see this? Which is dangerous, because if you follow what I'm saying, every $100 in your account goes 0.01. This equals 5% of your account. That's a lot, guys. senior traders program with my senior traders. So there it's with people with 10,000 US dollar accounts going all the way up to 6-figure accounts. The golden rule is you only have 3% of your account at risk at any given time. I don't care how many 10 trades, 15 trades, 20 trades you want to run. If your capital is big enough, you can run 100 trades. I'm fine with that. But at the end of the day, you're risking 3%. For a retail trader, that's terribly difficult because most of you start with terribly small account. And so you need to start becoming a little bit aggressive. And the stakes are already high with 5%. 5%, 0.01 of 100 US dollars works out to be about 5% of your account. 5% of 100 US dollars, technically speaking, is exactly or works out to be roughly $5. 5 US dollars. So for every 100 US dollars you have at any point in time, you are literally risking anything between 4 to 7 US dollars, but really you want to try and keep it at a neat 5, which actually works out to about 5% of your account. This is why for every 100 US dollars of your capital, you go 0.01. So let's say you start off with 1,000 US dollars. Final example, 1,000 US dollars is your starting capital to trade. You're like, you know what? I want to give this my all. I'm going to do it properly, blah, blah, blah. The maximum number of trades you're running is this. Number one, only one trade at 0.10, right? Because for every 100 you go 0.01. Or you could have 10 trades running, 10 different trades, Euro USD, Pound USD, all of them running at 0.01. One of the two. Or you could have a mixed masala. The one trade that you like, you put it at 0.05. And then the other ones, you break them down even small. But you can never exceed 5% at a time. You can break even, which will free up leverage and all that stuff. We'll talk about that before tonight's class is over. But importantly, before I move forward, comrades, colleagues, compatriots, temperature check. Are we clear on the basic rules for now? Yeah, Alvin. Yeah, you exactly. Here, you can't trade in clusters. Well, you can actually. I'll explain it. I'll explain it quickly. Is that wind or something? My office door is banging. I'll explain that. That's a very good question. I like that question. That's gonna go into how to grow a small account, which is what I want to end class with. Temperature check, guys. Are you with me? Are you with me, Alvin? I really like that question. I'm gonna come to it now. Right. All right, cool. Everyone is with me so far. Fantastic. Good. Right. So this is the game. This is how market structure works, the rules of trading, supply and demand. Supply and demand will work whether you respect this. It will work in terms of markets, not in your life. I'm saying the markets will just keep doing this. This stuff is not changing anytime soon. If you don't respect this, but want to follow this, that is to say, if you take a supply and it's a supply and it's valid and you want to go to a demand and you're like, look, at the end of the day, this is a perfect supply. Oh my goodness gracious, a beautiful supply, imbalance room met, area of value tested. It's not even a PCP. I've done my multiple time frame analysis. It's a golden thread. I've got a good broker. Everything should go according to plan. I don't need risk management. You will pay the price with your account. You will blow your account all the time. You will be our local favorite blower. Be careful of that level of arrogance in the markets, right? Markets are honestly, guys, are not a toy. There's not something to play with. Risk management is fundamentally important. Now, we've got a very good question around trading in clusters, all right? Around trading in clusters. And I wanna come back to that, Alvin, if you'll allow me in the next 5 minutes when I'm talking about how to grow your account. I just want to quickly wrap up leveraging and all that good stuff. But my goodness gracious, that's a very good question, and it's actually linked to how to grow a small account. So let's quickly move on now. So you guys now know my rules. $100, 0.01 for every 100 US dollars. Now we're going to talk about leverage, because your broker is going to talk to you about leverage. Leverage is basically how far do you want to leverage this superpower against your account. We've just spoken about the superpower. All right, with your trading capital, let's use an example of is 100 US dollars. And it's not a recommendation, it's just really what I guess most legit brokers are asking for a minimum a deposit, right? 100 US dollars. So it's actually quite a very relative example. It's not a recommendation. I always tell people start with what you can, right? I can't dictate capital. It's up to your pockets. If you want to play safe because you're going to make mistakes, then you want to sit somewhere here. And you want to stop yourself when you start making too many mistakes that help your account and figure out what the hell is going wrong. Right? This is a better account amount to start with statistically. And I tell people part two because then they just block me out. They just whoop, they stop. This is the part where everyone just mutes me. You start here between 250 and 300 US dollars. You can start with whatever you want, $1,000, even better. You just want to give yourself as many chances as possible. As long as you know you can also lose all that money. You start somewhere here. You want to trade it like 100 US dollar. What does that mean? It means even if you've got 300 US dollars in your account, instead of going 0.3 and risking 5% every time you trade, you're going to go 0.01, right? And slow the decay of your account down. Show you something cool. Let's say you start off with 100 US dollars. 0.01 means you're risking about $5 per trade, right? We've proved that already, which is 5%. Well, there are 25 US dollars in 100 US dollars, which gives you about 15 to 20 trades. 100 US dollars gives you, if you are patient, 15 to 20 chances. You can buy and sell 15 to 20 times. Some of you are going to want to buy the same thing 15 times all at once at the damn same time and be shocked your account blows. But it gives you 15 to 20 trades, which means you could average out. You could be wrong for the first 5 to 10 and be right for the last 5 to 10. But if you start off with this type of capital, $250 to 300, but you trade it like it's 100 US dollar account, which means you're using 0.01. Then what you essentially do is you tell yourself, well, listen, man, I am going to give myself the best chance to figure this whole thing out, which allows you to flip this from 15 to 20 to potentially, if you do the math, at 300 US dollars, anywhere between 55 to 60 trades. You can't get 55 to 60 trades wrong. I refuse. You can't. Not after doing my course. Yes, by yourself you can get 1,000. I get that. But not after understanding supply and demand. It's practically impossible. And what you do though is you tell yourself, my first 60 trades are my build. They are not gonna build me a house. This is not money it's not going to change your life. Let me just put it like that. This is not it. This is going to put a process in place. What you're looking for is Leroy said, now don't forget the promise. I want to put it out there. Remember, remote course or live class, it doesn't really matter. There's 100% guarantee. You get 100% of your whatever you paid. I don't even know what you paid. I know it was on a discount. Whatever discount fee you paid for the course. If you paid, I think you paid $180, or some of you might have paid $200, one of the two, or remote courses $150. But no one has ever paid for the full course in 2 years. We've sustained discount upon discount, literally. You get that money back if you can prove that you used my rules right here. All of this, if you can prove that I used your rules and I lost money and I blew my account, your rules don't work. You can show me that, and it's not hard, right? It's not like I'm going to debate with you. You're going to print me out your broker statement. I'm going to have a one-on-one with you, or one of my senior traders will have one-on-one with you. And I'm going to go through every single trade you took. Your broker statement, for you to prove it, will show us EP entry point where you put your stop loss, right? It will show us the date and time. And so what do we do together? Me and you live together, so we can see that the rules don't work. We're going to then go back to the charts on that date and on the time. We're going to cut out every single candle. Then I'm going to be like, right, you bought EURUSD at 1,00201 according to your statement. Do you remember this? It's there in your statement. You bought it. Let's see what you were seeing on that day. And then I'm gonna be like, why would you buy? Makes no sense. Look at the multiple time frame analysis. Look what it did. Oh, I'll be shocked because you'll be the first person ever to get this out of 365. You'll be the first to come back to me and say, look, man, let's go through all the rules. This worked, all the rules worked, were in place, and I blew my account. I'm like, God damn it. Markets are clearly changing. The rules didn't work, and immediately you get your money back. Right. Because that should be motivation enough, essentially, is what I'm praying for. Go find out where Leroy lied to you in the charts. And the best way to do that is to please do it the way I'm telling you right now. Go prove me wrong. And when you prove me wrong and you start off with $300 and it gives you about 50 to 60 trades, literally at a very cool pace, 0.01-ish, you know, while you figure stuff out. What that fundamentally means for you as a trader is at some point in time, even if you keep stuffing up the markets, you'll start trading like this. Your first few trades will be a loss. Oh, but what is it? $5. You're losing $5. And then your next trade might be $6. You're losing money. You're losing money, right? Remember, this is your capital. You're losing money. You got something wrong again. You go back. I forgot this rule. Class effect. I didn't even check the imbalance. My MTA was wrong. Mr. Alvin, this is the first version of clusters. If you can stop after 10 trades, taking them one at a time, if that's where you are, if you're at $100, you can only take one trade at a time. That's what people hate. The truth is, $100 capital means you can only trade 0.01 trade at a time. Unless if you break even, then you can take another one, which means you are literally earning in cents unless if it's a long-term movement, right? Because remember, 0.01 on a standard account pays you 10 cents per pip. Real talk. But if you take 10 trades wrong, well, come on now. At some point, you're going to figure out what you're doing wrong. I hope. It's my hope that you will. You still have this. And if you have 10 trades wrong and you only have $100, you still have something here. You've got about 10 more trades to go to make all of this up before blowing your capital out the water. So that's why I like asking people if they can to start somewhere here, but trade it like it was like this, so that you say, what is my cluster for the first 60 trades? But doing assessments after 60 trades, I think for a new time trader is a lot. So you'll have 3 pauses. You will take 10 trades in your life, not at the same time. You might take 3 this week. You might take 2 next week. You might take 7 next week. Whatever your cluster is, after 10 trades, pause. Am I profitable? Am I not profitable? Take another 10. Do better with the rules. You got 60 trades in this in this thing. Every time you trade 10 times, you come back to your group and you're like, guys, what's going on? Why did I lose CAD JPY? What's going on there? What did I miss? Right. Out of the 10 year, you will pick it up. You will literally catch yourself. You will literally save your own account. You will start to pick up some things. I actually rush. I don't wait for areas of value. I got 6 out of 10 trades here. I lost 4. And when I fix that up, Trading Journal will tell you all this stuff. If you're good, if you write things down, if you just write things down. Jordan Peterson, clinical psychologist, literally says you can become a better human being by writing things down. No therapy. You can literally self-evolve. It's not going to be the greatest self-involvement, but it's 10 times better than the human being you are. If you write down your thoughts, if you journal, if you write. And trading, I won't lie to you, you must write your trades down. You must write the rationale behind your trades, because after a week, if you're like me, that's why I don't like teaching on Fridays. Friday is my free day in the markets, sure, but on Monday I don't work, but on Friday I review. Why didn't I take a trade? I tell my partner, I literally go to that room on Saturday morning over breakfast. I'll be like, listen, I love you and stuff like that, but according to my journal, I took 6 trades this week. And the reason for that is You needed to go to the gym, and I took you to the gym. You don't want to drive yourself. You want to drive, no. So I drove you. And then after that, in town, you were hungry. So you asked us to get some lunch, and we got some lunch. And you started telling me about what this girl said about you in your classes, and you didn't like that. And then before you know it, it's 4 o'clock. It's time for me to walk the dogs, and I walk the dogs, and then I get the baby, and I get the baby. And then 6:30 p.m. I've got class, and then at 10 p.m., 9 p.m. after class, I'm tired. So it happened 3 times this week. I'm not making the type of money I want to make because that's what my life looks like. If I let time pass by and I don't note that what happened with my life today, I can't fix the problem. If I cluster 2, you have to. It's your business. You're not going to start a clothing shop and every time stock disappears because a worker stole it, you go, someone is stealing my stock at work. I don't know. You would never do that. You wouldn't start a bakery and every time you order 100 loaves of bread the first week, but your customers only bought 60. Are you going to be the same baker next week who's going to bake 100? Because you're losing 40 loaves of bread, you're throwing them away. Why on earth would you do that in trading? If you lose 4 trades that week, you need to find out the why. Why? Is it the rules? Is it me as a trader? This is something I didn't understand. Was there a news event and my entry point was stuck at that 15-minute moment of volatility, which pushed me back to my stop loss? You have to know why. Why gives you a reason not to repeat here. All of a sudden in week 2, maybe it goes up. Right? Because now is this a different set of rules? Why? You get my point, right? I don't want to hammer this too long, but this is apps. You can't, I promise you, you will think you'll remember. I promise you, you will not. You will not. Why not write it down? Even if you remember, even if you're such a genius, write it down and review it weekly. Ask yourself the big why. Now, moving forward, leverage, and I'm gonna come back to training to classes because there's a proper way to do it. I have not forgotten. Leverage then basically speaks about how the superpower works. So it's how they increase you from 1:10. You can have leverage of 1:100. And it's all based on fundamentally buying those units that I spoke about. And I don't want to waste too much time on that. It's also literally inside the PDF that you guys had, the last PDF from me. Now I want to talk about how to grow small account in the last 20 minutes of class as we conclude this trading in cluster state, because it's absolutely important. And I do still want your questions, guys. I know we're out of time, so give me the questions tonight. If there are any, I'll write them down and I'll answer them all tomorrow. All right, I don't want to start module 2 tomorrow with lingering module 1 questions. I would like just 30-second feedback from everyone at the end of class today, just so I know how you guys felt about class in general, right? So now, how to grow a small account. Cluster trading helps you review your trades, fundamentally stops you from repeating the same mistakes all the time, which is the only reason why retail traders lose. Retail traders don't lose in the markets because they are stupid idiots. Excuse me. Retail traders lose in the market fundamentally because they keep doing the same thing that doesn't work. They do it with pride, they do it with conviction, they do it boldly. The same thing that does not work. Guys, I am not lying. I've been around for a very long time. I've coached a lot of people. I've been coached a lot of times before. It took me 4 years, 3.5 years to realize I was doing the same thing that did not work. I could see myself blow accounts and I could see myself refunding accounts to blow accounts. Reason people always ask, why don't you give up? When you learn the truth about markets, you know that you can get rich from them. That's why people don't give up. When you go to people's houses and you're like, okay, what do you do for a living? I'm a trader. And you're like, all of this from trading? Goddamn, yes, all of it from trading. It's a desire. It impregnates you with the desire for success. The problem is, you don't know how to handle it. You don't know how to handle this thing, this passion that you now have for the markets. You want to make it in crypto, you want to make it in stocks, but it's what you don't know how to give birth to that reality. And you can be pregnant with your Forex dream for 10 years if you don't change basic stupid stuff like this. All right, and this is it. Retail traders lose all the time because they do the same thing all the time. They will dress it up as a new strategy. They'll do, fundamentally it's the same stuff. If you simply slow down the lot size and let your account grow, don't quit your job today, quit your job next year. Sorry about that, right? Take your time building your account, building some type of credence, right, around your trading. Now, how to grow a small account? Let's use $100 because that's going to be bloody hard. This is the tough one. Forget about $400. Let's use $100. You can only take one trade at a time, 0.01. That's 5%. Why do you want to do that? Because you can only risk 5%. Anything bigger than that is just suicidal. If you start risking 10% of $100, that's $10 per trade, per area of value. So if you do that, you only have anywhere between 7 to 10 trades to take. You have to be right. You have to be right more than 50% to be profitable. You must win 5 out of these 10 trades if you're going to make it before you lose your $100. That's a lot of pressure as far as I can tell. Now, let's quickly go to the charts. I want to show you something from what I've just taught you right now. And Sheila, this is literally a cool tool that I use, but maybe you will enjoy it. It'll make things easier, so to speak. EURUSD is not kind. All right, so it's hit this area of value here on the daily time frame where we do believe there is a supply that we can't take, or that I can't take. I refuse to sell here. I'd rather close my buy right now, and I probably should break even. I'd rather break even but not sell there. I'm not gonna sell here because again, imbalance has not been met. But I bet you find an imbalance on H4. I bet you're gonna find an imbalance on H4. Right, so you see on H4, clean. Then there's this clean, right? But and this is looking, a little bit deadly. It's looking like it's about to kind of like create a shooting star, which is price coming back down. But I'm not too worried. I'm gonna wait for a retest somewhere down here. Basically, I won't interfere. I'll see what happens. But I'll break even, or it's not much. It's only $10, man. I'm just gonna let it run. Excuse me. But I want a simple example for you guys. Oh, wait. Is it too late to get into this, baby? No, it's not. All right, we spoke about this. I said I was going to keep it on the charts. For a while, market sold off, then came back and broke. Markets are not going to sell here. Markets are going to go all the way to the top now. Let's use something even easier. When you see, because remember, so now I want you to put yourselves in the mind of a trader, which is your minds. You guys are traders. I want you to remember my rules of multiple time frame analysis. Number 1, number 2, number 3. You have generated a trade idea. How have you done that? You look at your governing time frame. You've made a conclusion that price is giving a supply going to demand. I think, yeah, yes, maybe, no. Can you repeat the question? Right, see the markets are giving a supply going to demand. Let's say, for argument's sake, this is the demand, which a lot of people are currently arguing right now, and I don't agree, but it is what it is. All right, we should explain why the month of October is green for pound dollar, which honestly for me looks like just a strong rally for us to sell again, right? So let price do what it did, because EURUSD did the same thing. But anyways, you're talking to your governor, right? So this is not gonna work right now. So let's just say the demand is somewhere down there and markets are selling. We can talk about the other complicated stuff another time. Right, then you go to weekly, blah, 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 leaving a supply going to demand, and you go to daily to find a trade idea. I'm not rushing. I'm rushing because I don't want to waste time on multiple time frame analysis. Right, so let's say you want to sell here, which you should. I don't trust this area here, but I like the accumulation and I want price to come to me. I'm a snob in trading. I want you to pursue me as a trader. I want the charts to pursue me, not the other way. Right, so we found your daily supply that we're going to use for whatever, for argument's sake. Very happy with that. Right. And then we decide this is where you want to sell. So remember, you got 100 US dollars. I want to put it all together. So you're going to do the manual calculation. Please don't be lazy. Learn to do this manually. Number one, 100 US dollars, 0.01. 0.01 is 10 cents per pip movement. All right. So this is your area of value. All right. You're going to draw your area of competition. You want to be triggered here, right? That's where you want to be triggered. You see that number there, 1,37. That's where you want to be triggered. And naturally, your stop loss is always above your area of value. You want to see that there. That's also perfect, right? So that's sitting nicely. And then you want to talk to yourself and say, well, but how much am I risking? And you only know how much you're risking based on how big your area of value is. Areas of value. So you're going to come to information line. All right, so the first way to do it is the manual way. You see this number here, 1,3922. Last, take the first four digits after the decimal place, and you're going to subtract between 13922 and 13789. Right, between those two, you're going to get how many pips this area of value is. Why? Because you're going to pay in dollars for however many pips there are here. Your area of value is reminding you of how much you're risking. It is the distance. You are risking the distance between your entry point and your supply. So you can see there, it says 132 pips. Not a calculator. I'm not on my phone checking Instagram or whatever else is out there to check. I want to do the same thing, kind of like pull out the manual side of things there'll always be like a slight tiny variant because of how accurate you drew this, right? So that's why I always double check myself. But you can see on the calculator there, can you guys see that? It's about 133 pips, yeah? And you can see with the info line, it says 1,32.8. So it's literally 133 pips when you round it off. So this is very correct, and that's correct. So now you know that if you want to take a sale on pound dollar on the daily time frame, this area of value is worth, what is it? 1,3, let's make it 133 pips. So you get to decide now with your account size. You're like, okay, fine. This is 133 pips. How much is that in dollars? Well, that's going to be based on how much power you use. So we know on the whiteboard, we've spoken about this, that on 0.01, 1 pip is 10 cents. So again, you can do this stuff manually, and you should love it. It's a business. You're checking your stocks, you're checking your how much it costs you to order these clothes, and you're going to put your markup profit to sell to other people. So I'm going to be like, okay, 133 pips times 10 cents. This area of value at 0.01 is worth $13, right? Do you see that? Do you see that? I don't know if it's clear, so I'm just showing you again on camera. It's $13. Don't lie to yourself. Don't take trades blindly because they look pretty and whatever. Do not sugarcoat the risk. It's $13. You have not yet calculated how much your broker's spread is going to be. You have not calculated that you're going to be a swing trader, and so you might actually have to hold this trade for 2 weeks. There's something called swap charges, swap fees, spread, swap fees. They're always in cents, but they add up, right? So it's not a lot of money, but they add up. But just so you know, $13, this area of value. Is this the best place to park your 100? Remember, you got 100 US dollars. You can only take one trade at a time. Already with the 100 US dollars at 0.01, which remember is the math we've done here, because all we've done here is simply said, well, at 10 cents per pip, 0.01, this area of value would cost you $13. But there's a problem. If you're a good business person, you're going to be like, yeah, but $13 Leroy is now 13% of my 100 US dollars. Is it worth it? It's up to you. You're going to have to decide for yourself. I like trades that I'm risking about 5 to 6%. Right, because then I know that a 13% hit is nothing. $13 is nothing. It's like I can take it. It's $100. But the problem is your buying power gets diminished. And if you have 3 bad 13 US dollar trades, right, that's 13 times 3 times. You're out of the game, really. What's left in your account, right? 13 times 3 is almost like $40. got $60 left, which is very difficult to get that mileage going. So just be mindful of all of that. But you need to know this. Now, there's this thing, and I think I've shared with you guys, pip calculator. It's a very simple one. I like it. I like to use it. It's very simple, simple, right? So it's gonna do everything that I just said. So I'm gonna drop this, and I think I've done this before on the Zoom chat right now. I'm gonna drop it to you for you guys in the Zoom chat right now. Right. So simply come there, and then what do? You pretty much input everything that I just told you. Everything about that trade. You've seen me on World, like go these are all the trades, but when I check on Monday which ones I'm taking. On Monday, I do the maths, I do the business side of the trade. Yeah, that's a valid supply. It's pretty, I can use it, sure. But yeah, it just balance, right? It has to make sense. Right. So you'd come to my pip calculator here and you're gonna write amounts in pips. Well, what's the amount in pips? You already know it's 133. Right, it's 133, and then this thing is linked. So what I forgot to tell you was pips value vary per asset. Euro USD might be 10 cents, but you might find pound USD might be 12 cents, right? Pound pairs pay a little bit better, generally speaking, right? Per 0.01. So you can imagine the bigger the lot size, the bigger the pay, right? So you want to really figure this thing out, right? So you put in your 133 pips here. Let's find the right pair. Let's not just get a random amount. So let's go pound USD because that's what we want to look at, right? So that's pound USD right there. And then your account, if it's in dollars, put it in dollars. So see this one here. One means one standard lot size. That's what the one means. It's literally saying, look, man, if you are using 1,00, this area, not profits, the area of value is worth 1,330. This is the one thing that those guys who like to over risk, over trade never talk about. They want to talk about how much a standard lot size can give you in pips, but they don't want to talk about how much a standard lot size is worth. Remember, one pip movement is worth $10 on a standard lot size. At 0.10, one pip movement is worth $1. 0.01 is worth 10 cents. So if I'm taking this trade, pound USD sell with the standard lot size, I am saying to my broker, yo, rich nigga in the house, I am happy to lose $1,330 on this trade if I'm wrong. And if I'm right, depending on where your take profit is, I'll make money, lots of money, right? If I'm right or wrong, right? So obviously that's not our example. In our example right now, we have $100 account. So what are we gonna do? We're gonna tell the pip calculator 0.01. Look at that, right? $13. Already done the maths manually, but I'm just showing you that this stuff works out either way. Better manually just to get a feel for your entire Forex business. So it tells you straight up, you're gonna risk 13 bucks here. Here's a concept I desperately need you to understand, and I know time is not on our side. Colleagues, can I ask for 10 extra minutes tonight? It's 27:08. If you say yes, then I know how to move about. Can I just ask for 10 minutes, please? 10 minutes, then I'm done. 10 minutes. Jay, all the way from the Philippines, it's probably like what? It's like, I don't know, Jay. It's like 2:30 a.m. and he's saying yes. He's the first to say yes, and it's 2:30 a.m. in his time. I appreciate all of you. Thank you guys. Sheila, Alvin, I know in Kenya it's about 9:30 now. Alvin, South Africa with me, it's 8:30. Oh, thank you so much, guys. I appreciate you. Thank you, Wongi. Thank you, Lily. Thank you, Soneni. Thank you, Nyasha. Right, fantastic. Good, guys. 10 minutes. Just want to finish this thing so there's no breaking chain of thought. You know, I do suspect there'll be load shedding at 9 p.m. on my side. All right, so I hope the ladies will keep my supper warm. Right, so look at this. 133 pips, we now know is worth $13. This is the most important bloody thing out of everything that I've said to you. And I'm coming, thanks, David. I'm coming to trade it in clusters. You need to make sure, ladies and gentlemen, to make sure you're not part of the silly retail traders, the dumb traders, dumb money, the traders who persistently want to do the same thing over and over again. The most important thing, more important than imbalance, areas of values, blah, 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 risk. There's no time. I'll come back to this tomorrow. Don't worry. Risk to reward ratio. Woo. This is your baby. This is your bread and butter. You do not mess around with this. Even if everything here is perfect, governing time frame is buying. It's a buy profile asset. It's in the 10-year direction of a buy. My area of value is fresh. There's a good impact. Blah, 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 blah. Multiple time frame analysis. Nah. If the risk to reward ratio is off, I'm not trading it. I bow to you right now. You'll see me say it on the public Telegram group. Buy this if you want. I'm not going to be in it with you. I don't want to be that child who doesn't tell people nice things. If they want to take the trade, they want to take the trade. But for me, from a business perspective, just because I'm right about charts as many times as I can be, doesn't mean I must be a prostitute. I can't jump on every trade. I can't hold my account out for every single trade. I love my account. I'm married to my trading career. I want to appreciate her. That means the trading opportunity I find must be worthy of her. And you define that by risk to reward ratio. What does risk to reward ratio mean? Real quick, if I'm going to risk $1 of my account, at a minimum, it's a 365 minimum. You know what? I'm not even going to rush tonight's class. We're going to continue with how to grow a small account tomorrow. But let me finish this side of it because there's so much more to tell you and I don't want to rush it. At a minimum, I think we wasted time with the CPI stuff today. I wasted time just playing back what happened today with CPI. At a minimum, if I'm risking $1, I need to make back $3. From a business perspective of trading. So let's go back to pound USD. We now know that our area of value, let's say we've got $100 US in the account. It is currently 133 pips. When I sit down with you, I need you to show me you know this. Whenever I sit down with a consultant from another business, they'll be like, listen, man, this is my sister-in-law is into fiber. She knows fiber stuff, the stuff, the stock, the cost of stock, blah, blah, blah. You have to know the business side before you go to your customers for the profit side. This is the business side. I got $100 capital. It's going to cost me 133 pips to hold the trade. That in dollar amount is $13 US because I know traders, they hide in pips. They don't even know how much is worth in dollars. My take profit target, where you're going to exit after getting profits, it must stand the test of 1:3. So which means if you're taking that pound USD trade, the sell, at 133 pips, $13, at a minimum, you need to make $39 US. That makes sense. At a minimum, you need to make $39 US profit for that trade to make sense. It's not a case of you buy the trade or you sell pound USD and then you wait for $39, then you close. Supply and demand. What if there is a demand in between where you're selling before making $39? What's going to happen to your sell trade? Markets are going to drop $10 profit, $20 profit. Boom, you hit a demand. Now markets are coming back. What are you going to do? You're going to hold and wait as you watch price eat all your profits back. That means for you to take the trade, your multiple time frame analysis must point out a clean entry and a clean exit. I never, ever get into a trade if I don't know where I'm getting out. There's no such thing. Unless if I'm invested in stocks. And then I'm not looking for an exit. I'm here to stay. Stocks is that marriage, it's a Catholic marriage. We don't divorce in stocks. In stocks, we go through the tough times, the highs and the lows, sickness and health. In Forex, if you're not worth my time, get out of here. Because I can always find a better trade setup. There's a question. Right. Interested to trade VIX75, but if I stick to the data time, I probably would be out most of the time. Very true. Because the range of the year, very true, 100%. VIX is a different story, man. Allow trade to more or less recommending I can go to start. Conversely, what would be the safe account side? Yeah, look, VIX I've just started a series on derivatives, and it's something that we're gonna pick up next week. So me and my little brother doing that for you guys. We've decided on 3 times a week. So on the days I have class, Tuesday, Wednesday, Thursday, after this power outages are done in the mornings, I'll be uploading back tests and stuff. So VIX on the daily is worth about $100. Those areas of values are actually worth anywhere between $100 to $150 on the smallest lot size. It's actually quite ridiculous. So now I need to first back test because remember VIX is in the real market. It's not exchange. It's a broker market, broker manipulated. Most of the times you're trading against retail traders and algorithms, right? Brokers algorithms, and there's a lot of manipulation. And I mean, in one day we picked up 16 market manipulations. I also can tell you right now that the way we believe demand and supply zones are broken on synthetic indexes like VIX, if a wick pierces outside of your area of value, but the body of the candlestick doesn't go outside the area of value, that's technically not broken. There's a lot of things I need to teach people around that stuff. But I think if I remember correctly, there's a lot size that looks something like this, which is half of 0.01. That's number one. So I'll first of all stick with this and just get used to it. Number one. Number two, your daily time frame has to become your governor. So that's what you need to work out. Daily is how you use the governor on Forex. Daily is the governor. So you really want to try and find entries on the H1. All right, and then later on you'll graduate to 15 minutes. But yeah, just look out for more content around that kind of stuff, Jay. 0.05, I would suggest that, and then make sure there's a clean MTA between daily and H1. Golden. You want absolute confluence. For now, I've found that absolute confluence is 10 times better. And Deriv, because Deriv is a broker that's manipulating product, literally settle for the lowest demand and the highest supply. Because what they'll do is they'll use long wicks to break other demands all the way to get to the right one. So within that MTA, settle for that. For now, Jay, I'm so sorry, man, but you're gonna have to just kind of like be okay with that. And then maybe I'll break more time and talk more on it, if that's okay. Right, so this is what risk reward ratio is, 1:3. For every dollar in the market, I want to at minimum make back $3. This is how we make money. You'll see me say things like this. You saw with EURUSD, I just told you I'm risking $10 because of where I put my stop loss. All right, I'm risking $10 on this trade, but I think I'm going to make 100, or I want to make 100, right? If I don't break even, I'm looking to make $100, etc., etc. And that's the kind of setup you want in your trading. You want something remotely that looks like it understands risk to reward ratio. All right, so let me quickly see. I see I'm running out of time. Okay, I might as well just show you this thing, because yeah, screen 4, screen 5, so you guys can see a live account. There's another breakout there, USD JPY, but we spoke about this in class the other day. I think it was Colin was asking what's going to happen there, and I see more upside, man. I'm not really too worried. I think the next big supply is up here, so markets are going to go bullish. So find yourself a nice entry on the dailies, H4s, etc., etc. Yeah, but anyways, this is what I want to show you on EURUSD. See markets, there we go. Markets are retraced. You see this? Markets starting to come down, and that's fine. It's not a fear hazard. My first buy here, where is it? See there? It's 0.1 immediately, which means the full denotation is 0.10, right? So I'm going at 10 lots. No, 0.10, 0.10, which means $1 per pip. But look at the stop loss for this buy. So there's this buy down here, this one right down there, and then there's this buy here, and there's one with the stop loss all the way there. In case this whole area gets broken and price comes in, I am very patient to wait for price to find its bottom, right? That's why I do that. I don't want to confuse anyone. Don't worry, but I'm simply saying if markets come and trigger my second trade here, I've given them this whole room to breathe, right? But this trade is worth about $5. See there it says minus profit. I am risking $5. That's all. But it's more amazing because if I get what I want out of price, and a little retracement will never scare me. If I get what I want out of price and markets make it all the way up there, I'm using $5 of my money to make 97, and the second trade to make 103. So we can average these trades out to say I'm risking $5 to make $100. What does that mean? My risk to reward ratio is 1:20. That's it, guys. This is the DNA of 365. This is the reputation behind my trading firm. I will use little capital and stretch it out. If it was $5, now think in millions. Let's say I'm risking 5 million. As long as I'm making 20, actually that's 1:4. As long as I'm making 100 million, that's 1:20. I'm okay with that. You have to make sure that you are playing behind these rules here, 1:3, etc., as a minimum, because if you do that, you get to live another day. And this is how, and I'm going to end my last 2 minutes with you like this. Don't forget our example. We've got $100 account. You can only go 0.01. Let's do the maths together. This is how you grow a small account. This is how we're going to do the cluster trading. This means at any given point in time, if trade 1 is running at 0.01, you are already at 5% risk. I'm going to have to show you how to grow a small account on TradeView, on chart by chart, using order blocks tomorrow. But tonight, go to sleep with the mathematical equation. So check this out. We know that 5% is $5 roughly of an area of value, right? If we're really happy about it. So that means you may not be able to take pound USD, because pound USD is already at 133 pips, which technically speaking is $13. So you need to find a better area of value. That's one option, but that's not true. You don't never have to run away. All right, I don't want to lie to you. Never have to run. This is pound USD. See that there? You do multiple time frame analysis before you run away. We're going to drop to H4. So now you know that this whole area in yellow is 133 pips. But in H4, when you drop down, you're like, oh, Leroy likes daily because I'm a beginner and he doesn't want me to miss out on the trade. And I need to teach myself patience because on the daily, it's a swing trade. I have to wait. But if I was a much more articulate beginner, I'm looking into the H4. What's this? There's a supply here. There's a supply there. There's a supply there. I don't know if you guys can even see them, but there are 3 supplies inside. Why would there be 3 supplies? Well, it makes sense because the daily area swallows all that noise. And that's what you really want when you're starting to trade for the next 6 months. But I said, at the very best, please, only H4. You never go lower than H4 because you're going to confuse yourself and you're going to mess up your stats. But look what I'm going to do. I'm going to start to do something like this. I'm like, oh, okay. This is the highest supply inside the supply. Can you guys agree with me? There's a bearish engulfing pattern. We'll talk about it tomorrow in module 2, but it is a big supply. Prices left, fresh touch has already happened, market's gone, which means your entry point has changed. So now your entry point is somewhere here. If your entry point has changed, well, that means the value of pips that you're risking has reduced a bit. Might not be perfect. Then you go. So we're gonna go from entry point to stop loss. All of a sudden, you're now on 82 pips. Still inside a daily supply, 82 pips. You're gonna come to your calculator, and because of out of time, I'm gonna do it automatically. Oh, okay, look at that. Now you're risking $8. So this can actually get better. You don't want a situation where you're just drawing random zones to make it very tight, super tight. Actually, this is wrong. Look at this. The reasonable body is the green candle, right? So that means this can come up a bit more like that. That's it. Because if you take the wick of the reasonable body, which means we can actually reduce this a little bit more. Just a little bit more. Right. So then that's 6 something, if not 0. Right. So let's call it an odd 7. So 70 pips, probably $7. Right, $7. So that's 10 times better. So now you're within that 5% range. That's the $4 to $7 range, and in between you want 5. Right. So you got $7. And if you look at your area of value properly, and you go back to the daily time frame, you will see that now you're hoping to get triggered by this blue line here. But in terms of multiple time frame analysis, you have confluence with the daily. You are inside the daily, right? So someone like Leroy, someone with the bigger accounts, let's say you got the $300 account I was talking about. Trade 1 will be here, outside that daily. You want to go trade. If you had $300 this is what I'll do. This person, what I'll do, I'll go 0.01 there. Remember, between this entry and my stop loss, that's $13 on trade 1, because trade 1 is covering everything. It's trading 1. This is all trade 1. and then I'll have another trade, another 0.01 inside here for a higher sell, right? Which means I'm risking less, also 0.01. So in total, if you think about it, you're risking $13 plus $7, which is equals $20. If you were playing around with that $300 pound, which is still less than 5%, right? So then now you've got two good trades going. The deal, however, is risk to reward ratio, which I want to conclude by, guys. Thank you for being patient with me. I'm about to conclude. Now let's go back to $100 example before we end class. I told you earlier on $100 will give you 15 to 20 trades. Here's why. If you're risking about 5%, you're paying about $5 to $7. That's why. $5 to $7, you got 15 to 20 trades in $100. Now let's say your first 10 trades are losses. You lose them. You suck. Life is tough. Leroy lied to you. All right, the rules don't work. Oh my goodness gracious. You lose them. That's $5. So you lose $50 of your $100. That makes sense. You're risking $5 per trade. You take a cluster of 10 trades, right? Out of those 10 trades, flat out loss, you like Forex is a scam. And then you figure out what you did wrong, and then you start to do things a little bit better. And then your other 10 trades, you win them. Let's say you lose 2, win 2, lose 2, win 2, whatever your equation. At the end of the day, let's say you're a 50% trader. You lose 50% of your trades. This is the gift of leverage at Forex. You can lose 70% of your trades, only win 30%, and still be profitable thanks to the superpower of leverage plus risk to reward ratio. Let me show you what I mean. So then you win 5 trades. Guys, I appreciate your patience. You know, oh, by the way, if I stop talking, it means power is gone. Like, boom, right? Game over for me. Right, you win 5 trades. Naturally, you are assuming, Leroy, that means I've made $50 and I've broken even, I'm back to 100. No, you're not. Because if you follow my rules, which you must, you are only taking trades that give you a risk to reward ratio of 1:3. So you're looking at a supply and you're saying between this supply, I'm going to sell, and my next demand, the demand gives me enough room for price to give me 3 times the value of 1:3. Let's go back to pound USD so I can show you what that means. There's a tool to use that won't waste a lot of time, easy to use on TradeView, but I suspect we need to delete all these things. I suspect we need to delete all these things so that there's space, there's space, there's space, there's space. Right, so this is our area of value on the daily. We're looking at this chart. We want to sell. We know that to sell, we need to sell high, and we're watching price coming to us. When price comes there, where is our take profit? We can say today there's a Talitha area here, and by the time price gets there, maybe markets would have created an imbalance. If markets create an imbalance, what does this mean? It means that this is potentially going to be a demand. True or false? If markets create an imbalance here, right, it means they might leave buy orders. Markets right now are consolidating here for buy. That's an imbalance. Now, let's say we don't like the trade. Remember, $100 is too much for us, blah, blah, blah. We can't take a $13 loss. So we're going to take this H4 supply inside the daily. So there we go. So now we're waiting for price to, even if price enters the daily with $100, we're going to have to wait for the H4, because on the H4 supply, we're risking $7. Right, that makes sense. But we're now aware that there might be a creation. So let's say fast forward next week, there is a demand. Let's say markets leave a demand here. That means it is silly for me to think like Leroy. You are not yet where Leroy is. You're not a masterful swing trader. You have to take an entry point and take an exit point. You start from a daily supply to the next immediate daily demand. Why? This daily demand is going to turn price against you. So you better take profits here. You better take profits on the immediate area. You take that 10 times. You take 10 trades that look like this. If you take in the demand, you're buying into the next immediate supply. You don't hold King Kong for forever. You don't assume that markets are going to break and going to go to the governing demand and I'm going to be in the trade for 6 weeks. It is not easy. Your psychology can't do it. I can tell you right now, you're going to try, so you're going to fail. What you're going to do is you're going to cut your profits. You're going to exit at the worst possible time. Markets are going to get here, bounce. As they're coming back up, your $50 is going to become $10 profits. You're going to panic and you're going to close and you're going to make $1 profit and owe the broker 60-cent swap fees. All right, so you take, this is where you're going to take profit. You're going to come here, you see this little ruler? Wrong. You're going to come here. You're going to click here. Long means buy. Long means buy. Short means sell. We are selling. So we're going to take this tool, short position, and we're going to click it where we are going to enter. Just like that. Click it where we are going to enter. The red is to indicate what you're risking. The red is what is the $7 you've just calculated. You're going to make sure the red sits perfectly along your stop loss, which is the blue line. And this part here sits perfectly on the second blue line, which is your entry point, like that. You see where the red is? The red is the entire area of value. The green, you're going to scratch the green up to the next immediate demand. So let's say next week, this is a demand. There's an imbalance. It's definitely a demand. We know that it's a valid demand. Smart money bought there. Then we now know this is our scale of profitability. Then you're just going to have, you see there, risk/reward, 3. That means this is a 1:3 risk to reward ratio. That means if I'm risking $7, I'm most likely going to make $21. This trade you can take. It's not a signal. I'm saying from today's analysis, I'm like, you see the governor properly, blah, blah, blah. But in terms of a trade setup, this is it. This is what I mean by risk to reward ratio, 1:3. I hope that's clear, because of time, I have to move on. Now, if that's the case, look at what's going to happen to your $100 US. You lost 10 trades, so you lost 50 out of 100. But if you're taking 1:3 and you win 10 again, there's the maths now. Here's the nice part about Forex. Because you're taking risk to reward ratio of a minimum. Remember, it's a minimum. You can go, the more the merrier, 1:7, 1:20. The more the better. That's the power of swing versus intraday trading, by the way. Right? You can still get R&R intraday trade. I just feel like swing trading offers you more. Because you're taking a risk reward ratio, a minimum of 1:3, it means every time minimally you risk $5 in the market, minimally you need to make $15, because for every $5 you're making 15. But let's do the math. But then we say you are going to take 10 winning trades, right? Risking $5. But technically speaking, every time you risk $5, you are making at a minimum, according to that structure trajectory I just showed you right now, $15, which means every time you won 10 trades, one trade you made 15, or 15 times 10 equals $150. Now let's check your trading account after 20 trades on $100 US. You first had $100 and then you traded terribly. You traded absolutely terribly. You lost $50 in the market, which means you are now left with $50. And then after that, you figured out what was going wrong, right? And so when you figured out what was going wrong, you changed your game and you started making money. You made $150. After losing 50% of your trades, or 50% of your trading capital, your equity is back up to 200. Does that make sense? This is the game. You get risk to reward ratio right together with my basics here. You are golden. Doesn't matter how many times you tank. As long as your account is growing, you and me are happy people. Guys, I want to go on and on and on and on and on, but we're out of time. Can we keep the questions for tomorrow and feedback? I'm so sorry to cut us off like this. We have been going for almost 2 hours, 30 minutes, and I need to stop recording so that it can, Zoom can convert before power cut happens. But I appreciate all of you. I hope this made sense. I hope you guys got something out of this. That's risk to reward ratio. I will pick it up tomorrow. But it's just something I wanted to leave you guys with, something to kind of like chew on. All right. So shake my hand, guys. Have a good night. Sorry, man. I mean, South Africa is going through load shedding, so I am in a rush to kind of like end class. But I appreciate this, guys. This is so important. I create traders for a few months to a year to 2 years, traders, generally speaking. But the people who rock with this long term, they become fund managers. This is what we do as fund managers. When we're managing capital, this is the maths behind it. Thank you kindly. Thanks, Ronnie. Thank you so much. Thanks, Alvin. Shake my hand, guys. I appreciate you. Have a good night, amazing people. Cheers, Jay. Jay, I'm so sorry, man. Your nightmare is about to come to an end. These late classes in the Philippines, they will come to an end. Awesome class. Sheila, that means you win. All right, great. I'm happy. I'm happy you're happy. Thanks, Nyasha, guys. Good night. Have a good night. I'm going to end the class right now. I'm going to stop.